What's going on, guys? Eric here, and I just recorded a video on the divergence strategy, and somehow when I recorded that, the audio and the voice, or the audio and the video got out of sync. So I'm just gonna give you guys a brief introduction right here, and then the rest of the video is gonna continue without having to see my face because the video got messed up on the previous video. But yeah, thank you guys so much for watching. I hope you enjoy, and we'll take it over to the screens right now. Hey, what's up YouTube? Eric here from MajorLeagueTrading.com, and in this video, I want to break down the divergence strategy. Now, this isn't the typical MACD, RSI type of divergence that maybe you've been used to. This divergence strategy is using the four main stock indices, looking for opportunities in time where they're giving us the price of the actual indices are giving us an indication for a potential high and low of the day. Now, couple quick ground rules with this strategy. Really, the only thing you need is 4 5-minute charts. You can see right now what I have up on my screen. I have the S&Ps in the top left. I have the NASDAQ in the top right, the Russell in the bottom left, and the Dow in the bottom right. Now, these levels that you see on my screen, those are levels that I come up with each and every morning as potential support and resistance levels for the markets on a daily basis. And I come up with a scenario of if the market does this, then I'm looking to do this from these given levels. And one of the ways that I can enter into a position from a level is actually a divergence. Now, to simply define a divergence, it is just when one market is making a new high or a new low and one of the other markets is not. So, for example, if the S&Ps are making new lows on the day and the Dow is not, that would be considered a divergence. If the S&Ps, Nasdaq, and the Russell are all making new lows on the day and the Dow is not, that's still considered a divergence because we have one of the four indices not doing what the other markets are doing. So let's take a look at an example in this from today, and you can see this is 5/7 2020, 4:10 p.m. here. And what we're looking at right now is we have the S&Ps in the top left, Nasdaq top right, Russell bottom left, and the Dow in the bottom right. And what you'll notice here at about 10 o'clock is the S&Ps comes down, gets a new low on the day. Nasdaq comes down, gets a new low on the day. Everything seems pretty normal there. Russell comes down, gets new lows on the day. But notice what happens in the Dow. The Dow actually ends up holding its low of the day, which is right down in there. You can see there's a little wick here on this move, and we end up holding that low in the Dow and are setting a divergence at that point. Again, this is the exact example I gave in the first little intro there. Now, there's a secondary divergence here on the screen as well, which is going to be when the NASDAQ comes down here and gets new lows on the day right there. So NASDAQ pops down, gets new lows. Now it gets an extra check and turns into an A plus trade for a couple of reasons here. And this is exactly what I quizzed members on today in the trading room here. So I popped the question in there. I saw this set up. I was working on the options course. I needed some screenshots. I logged in and I saw this. So I asked the first person that can respond with the time of the divergence in this screenshot and the kicker that makes it an A plus play will win the divergence indicator and the free training that I have on this particular strategy. I only use two strategies, level to level and divergence. Spoiler alert, there's two right answers. Either way, let's cover those two answers, and just so you guys can see the screenshot, this was the screenshot that I put up for the room members there, which again is going to be the same thing that you guys have right in front of you now. It's just the end of the day now. That screenshot was taken about 12:30, 12:25. So, like I mentioned, there's two potentially right answers for this. The first right answer is going to be right down in here at 10 o'clock for the Russell. The reason that that ends up being an A plus play is not only do we have the divergence, right? The Russell's making new lows on the day, and the Dow is not, right? The Dow is holding up this low from the morning right down in here. We almost traded to the level, a couple ticks away from it. No big deal there. But again, it's holding up this low, not making a lower low here on the day while the other three markets are. So that gives us a pure price divergence among the indices, which is great. That's exactly what we're looking for in order to be able to take a position. It's kind of like, all ships kind of flow and rise with the tide. This is basically that. The NASDAQ, or the Dow in this case, was saying, hey, I don't want to go lower. I want to go back higher, or I just don't want to go lower right now. And that ends up marking the low of the day in the S&Ps, right there at about 10:05, and also in the Russell there, right? Now again, the reason the Russell ends up becoming an A plus play is because it's right into a level. Now, it's into a level. We just reacted off a level at the top side there by one tick. We came down, we pushed through, we got a little bit of a wick there through the level 1270.50s, but we're into a level with a divergence, and this would require us to be taking a long position, right? Looking for the markets to rally from this particular point, this divergence and this level. And guess what? The hourly chart is actually in an uptrend at the moment. So while we do have some things going on the weekly chart where the weekly chart's trying to battle the daily here, we do in fact have a daily uptrend and we have an hourly uptrend. So on a short-term intraday basis, we have good high probability chance that this divergence is going to work in the Russell, and that makes it an A plus play. Now again, like I mentioned, there is two right answers to that question, and a bunch of members got this right. And this second divergence is going to be right here. When NASDAQ comes down, gets new lows on the day, this is like 1045, 1040 this morning, guess what? S&Ps, no new lows on the day. Russell, no new lows on the day. Russell's lows are way down here. We got a lot of room to fall for the Russell to get new lows on the day. It doesn't do it. NASDAQ's getting new lows right there. Guess what? Dow, no new lows. It's not even actually getting through the the pullback higher low from the first divergence about 40 minutes prior. So now we've set not only one divergence in the Russell, we've now established a second divergence in the NASDAQ that ends up becoming an A plus play. And the reason being is, one, we have the divergence, so check. Two, we have a level, 90.34s. This is a level sent out to members in the pre-market session for pullback zones, 90.57 quarters to 90.34s. Check. So we've got the divergence, we've got the level. And then the third thing is we have an uptrend on the hourly chart in the NASDAQ. NASDAQ actually this morning popped up, got new highs over yesterday's highs, and it was just a simple pullback here on the chart. So we have all three things in alignment that make this an A plus play. Now, the question is, how are you able to then take this strategy? What are the rules around this strategy in order to take a position? Now, in simple terms, the very basic strategy is when we establish this divergence, we allow the bar to close. The lowest low or the highest high on the chart when one of the other markets didn't do that, right? And we allow that bar to close. In this case, we're looking at a long in the NASDAQ, right? We would wait for price to break above the high of this low bar. Again, the high of this low bar, and put stops below our low. So we have a 1 bar 5-minute risk in this chart, in this example, for the NASDAQ. Same thing here in the Russell. We would wait for the bar to close. We would get long on a break above the high of the low bar and put our stops down below. Now, again, there are some more kind of ninja entries, if you will, when you're coming into levels and you're getting actual signals on this. Now, what that looks like here, we'll go ahead and just click Control E on the NASDAQ. I ended up building a indicator for, maybe it'll work. I ended up building an indicator here for the divergence so that I can plot red or green arrows on my chart to tell me, hey, there's a potential divergence here. Hey, there's a potential divergence here. And you'll notice we end up getting that a couple times today, right? We end up getting it here on the breakdown at 10:10 where all of the other markets get new lows. We end up getting it again here at 10:55 when the NASDAQ is the only one breaking new lows. And then you'll notice up here at the top, just behind this little high ticker mark, 91.26, we end up getting it again on the day because guess what? NASDAQ's making new highs on the day. Dow is not making new highs. Russell's not making new highs at that same time. and neither is the S&Ps. So we're looking in this strategy, we're looking to identify potential highs and lows of the day, and we're waiting for one, the markets to establish those highs and lows. We're waiting for one of the markets to break those highs or lows, and one of the other markets to not, in this case, like the example with the Dow. And then from there, we're looking to take the entry above or below the high of the low bar, and we have just a 1 bar risk in that. So what does that look like in terms of, a stop loss and risk reward and things like that here in this trade example from the NASDAQ? Now, if you waited for everything exactly as it is with this trade, you're looking at getting long here over the high of this bar, which is 90, 50, 75s. So let's call it 90, 51s, right? Your stop is going to be below the low of this bar, which is 90, 30 quarters. So I've given you the full strategy, waiting for the highs and lows to be broken by one or more of the indices and the others to not. I've given you the trigger of how to get in, which is that 5-minute single bar break above, break below strategy. Now, the question is, how do you get out? How do you manage this position? Well, the first target that you should have is going to be the opposite side. It's going to be making new highs on the day or making new lows. So in this case, for our NASDAQ trade here, we're looking at getting out on a new high up over 91.09s. We end up hitting that here 45, 50 minutes later after this trade is triggered. We trade 91.1075s here. So we're looking to get in right here. Boom, we get triggered into the next bar. We place our stops below the low, and we put our first target right up here on the new high of the day over 91.09s. Now, for easy numbers, 90.51s, let's just call it 90.50s, up to 91.10s, right? That gives us about 60 points worth of potential profit in this trade. And we have a 1 bar risk right here, which ends up being about 20 points. Now, again, 20 points on this. If you're trading, you could stop me and say, well, hey, if I'm trading the NASDAQ futures, that's $400 per contract that I'm risking, right? But you now have so much more flexibility with the products that are available to trade. You could trade this with Nadex. You could trade this with the micros. You could trade this with the QQQs. You could trade this with the QQQ options. You could even look into a stronger name, something like maybe Apple or Amazon, Tesla, something that's in the NASDAQ that's super strong on the day. Maybe it's in an uptrend and it's just pulling back during this move. Maybe it had an earnings announcement and it rallied in the morning and was now getting a little bit of a like mid-afternoon or mid-morning kind of pullback, and it's stronger than the Nasdaq because it's actually putting in a higher low at that time as opposed to the Nasdaq, which is putting in a lower low but giving us this potential signal for being a low of the day. um, so yeah, there's a number of different ways you can trade it. Again, with all of the products that are available to us. I did want to do this breakdown video though and show you guys just how simple the strategy is, and then how I was able to then take that and spin it into a indicator that now plots me a red or green arrow on the chart when I should be looking at paying attention, and gives me a really nice visual representation there on the chart in the levels, all of these things that I'm looking for, and all of my criteria is clearly defined for this strategy. So I hope you guys enjoy this video. I hope it helps. Again, all you need is 4 5-minute charts here. You can populate these with the SPY, QQQ, IWM, and DIA. If you don't have the futures data for some reason, it still works the exact same. You'll still see the same thing here. I'll actually go ahead and do it for you there. We got the QQQ and we got the SPY. Boom, there you go. You'll see the QQQ comes down, gets new lows. SPY does not. We still get the signals, and boom, we still get the signals on the top side there as well. Again, I prefer to just chart the futures itself, but either way, you can do it with the SPY, QQQ, IWM, DIA, all that fun stuff. So anyways, thank you guys so much for watching this video. Congrats to the room members there that got the answer right and are able to identify these trades even without having the indicator on their screen. But yeah, so again, thank you guys so much for watching. As always, give me a thumbs up on this video, click the like button, hit the subscribe button so you know when we post future content here on the channel, and leave me a comment down below if this is making sense or you guys want me to do a follow-up video to this, kind of breaking it down a little bit more and maybe even show a trade example how I manage the trade using this strategy. If that's something you guys want, I could definitely do that for you guys. So take care, hope it helps, and I'll see you guys on the next video. Peace.